Hey everybody, good to be here today. It's Wednesday, time for managing your options portfolio. My name is Brent Moores, and we're gonna talk about a few different things today, including managing specific positions in an options portfolio. And we do that each week. We manage a variety of different positions, but this week I want to also expand kind of what we're looking at and what we consider when we talk about managing an options portfolio, and that is, what are strategies that you may decide to use, and how can you kind of find out whether a strategy is working or not? And one process for that is backtesting. So I do want to hit that up here in just a little bit. Before we get too far into it, let me just mention this. I'm supported by Ben Watson in the chat. Always appreciate Ben. I've been working with Ben for over 2 decades now. He's a very knowledgeable market trader and educator. He is kind of the face of Schwab's live workshop. So if there's a workshop in your town, make sure you check that out. You'll like it. I can almost guarantee that. And you can also follow Ben on X at Ben Watson CS. You can follow me on X at Brent Moore CS for additional content throughout the week. Some familiar names in the chat. Glad you're here, everybody. Appreciate you. Let's move on. And before we get to the main subject at hand, let's hit a few of the disclosures up. Options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And rolling strategies can entail additional transaction costs. A paper money virtual trading application will not assign a short option early, which is different from a real trading account. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. I'm not going to factor in commissions or fees in any trades we place today, but just realize that is a consideration. All right, everybody, let's head on over to the thinkorswim platform and get started here. This is the S&P 500. Look, we've had a little bit of a sell-off in the market. I mean, we've come down right today. We're holding our own. We're up maybe a smidge today, but over the past week or so, we have dropped below not just the 20-day moving average, but below that 50-day moving average, broken our low from before. This would probably, I would consider this low right here probably to be a valid support level. We'll see. We'll see if it holds. We got NVIDIA earnings coming out later today, and that certainly can affect the market. But when you're trading, there's different strategies that you can try and use. There's different trading approaches that you can use, and that begs the question, what's the right approach? And sometimes maybe you want to test out a strategy, and that's the great thing about paper money. Paper money is not a perfect simulation of live trading, but it's a pretty good experimental ground. One of the challenges people have with paper money, though, is, hey, if I want to test out a strategy, how many different trades do I need to kind of validly test out that strategy? You can't do 3 trades and see that they turn out well and say, oh, this is going to be a great strategy, or vice versa if they turn out poorly. You need a statistically valid amount to draw an inference in it, a statistical inference on that. And so if you look, how many example trades do you need for any strategy? And of course, if you look, you'll find that probably a lot of people from a statistical standpoint would say a minimum, you probably need about 30 trades, 30 bits of data to start to draw some inference there. And getting closer to 100 pieces of information is probably even better. Well, it can be very difficult if you're just trading these in paper money, waiting for the trades to progress out. Well, one way to expedite the testing is to do what we call back testing. Backtesting is going back in time and seeing how a particular strategy is going to work. Now, this isn't going to be super comprehensive on backtesting today, but I want to talk about a couple different possibilities. And I'm not going to talk about a lot of different strategies or systems. I'm going to basically use, just for our example, a 20 and 50 day crossover system. Now, there's a lot of different systems that you can use. I'm not recommending this, but I will say that crossover systems are fairly popular, the basis of very popular trading systems that traders use. Okay, so I have a 20-day 50 moving average and a 50-day moving average on my chart. You can see that right here. How do I go back in time? Well, there's two possibilities on the thinkorswim platform. One is to use what's called thinkback. Another is to use on demand. Let's talk about both of them. So here's what I'm going to do. First of all, if you're doing trades, do trades historically on stocks that you would use. More liquid stocks, typically for options trading. We talk about this almost every week in the webcast, why liquidity is important. So what I'm going to do is I'm just going to start off with the stock, and I'm just going to pull up Coke, okay? Everybody knows the company, Coca-Cola. Here we go. If I want to go back in time, and let's say I was just trading the stock and going back up. And so what I'm going to do here is I'm going to go and I'm going to click on, I'm going to go back in time. So I'm going to click on the time frame up here, and I'm going to go back to time interval, and I'm going to go back to like 10 years. And I'm going to make sure it's daily data here. And I'm just going to zoom in. Now, you could cheat, right? You could cheat and say, ooh, I want to buy right here, the very low, and get out right here and see how, see how I did. Well, obviously it would turn out just fine, okay? It would turn out great. Well, let's do this. Here's what I'm going to do. I'm going to zoom in, okay? I'm just going to zoom in the past, just click and drag. And so there we go. And then what I'm going to do is I'm going to scroll forward. And I don't know where I am in the process here. And so I'm just going to go to here, and I don't even know what year am I. I'm in 2022 right now. I can check by looking at the date up here. And I'm going to go forward until I get my 20 and 50-day crossover. Now, you can use whatever you want here in terms of your system to buy. If you want to throw a MACD or something on the chart, great, do that. If that's part of your system that you want to test, go for it. But just, I want to this is just a demonstration purpose. I'm going to say, when we get the crossover, we're going to call that a buy. And I could say, well, I want to buy on, we'll call this a date of where we crossed over. This is on 7/25. Let me just jot that down. Actually, let me put the year down too. 7/25/22. And I'm going to get out at a certain point. And we'll say, for our purposes, just when it crosses back below. Well, we're looking for the cross. Oh, here we go. We crossed below on, we'll probably go down to this day here, I guess. 9/14/22. 9/14. Let me jot that down, 22. And what you could do is you could just say, what price was I buying at on 7/25? What price was I selling at on 9/14? And come out and say, that's how that worked for that particular time. That's one data point. That's for stocks. What about options? Well, what I can do for options is, first thing, I can go to the Analyze tab. I can go to Thinkback. I can go to the stock I'm looking at, Coke, and I can go back in time. And I can go back here and I can go to 7/22/2000. So you put the date up here of the Thinkback date. And then when you look at it, let me just get rid of this. When you look at it, what you're going to see is, oh, here are options. And you go, oh, those are great. Looks like an option chain. But keep in mind, these are options that expire in August of 2022. These options are long gone at this point. But on this date, what option would I pick? Well, let's just say I'm doing a long call and we're buying about 50 days of till expiration. I'm going to go to September options. These are the options and the prices that were available at that time. Now, for our purposes today, I'm just going to go with the at the money contract. The stock is at 61.36, which is almost right equidistant between these two. I'll default back to just going slightly in the money, and that's my purchase price on the call. So I'm going to click on that, and it brings up a trade at the bottom of the page. Now you're going, well, look, the option probably traded at different prices throughout the day. This is an end of day price. So when we talk about thinkback versus, which is what we're looking at right now, versus on demand, which we'll look at in a minute, one advantage, I guess, of on demand is you can get intraday pricing. Thinkback is end of day pricing, end of day pricing. Now, the reality is you may not know when to go intraday here. If you're a day trader, you may be looking at intraday charts or something like that. But for our purposes here, what I'm saying is just kind of using our normal 20, 50-day moving average crossover system, this very well may suffice, just looking at intraday data there. So that's what we're doing. So I just wanted to clarify that. There's pros and cons to thinkback and on demand, and I'll try and go through those with you. But one of the I guess maybe pros or cons of thinkback, the cons of thinkback is it's just priced once a day here on that. Okay, let's move forward. So what I'm going to do is I'm going to click on my ask price. I may have clicked on it twice. So I click on it twice. I've added it twice. Let me get rid of that. Okay. And then I can say, well, when am I getting out of that trade? Well, let's go. Let's look. And I'm going to go to September 14th. That's the date I wrote down. And we're going to click on that and see how we would have fared. If we just did a long call, 20, 50-day crossover, we would have lost. You see the little brackets around the 226? We'd have lost $226 on that trade. Now, Chuck in the chat said, hey, you had earnings. Yeah, I did. And if that's part of your rules that you want to test and say, look, I'm not going to do earnings, I'm going to avoid earnings, that is absolutely great. I'm kind of just paring this down to as simple a possible system as I can. I totally ignored whether there was earnings or not. And so, but that certainly can be a factor that you add that in there. Okay. Now, let's say instead of doing a long call, we decided, well, let's do a short put vertical. Can you do that? Yeah, you can do that. You can do any of this data here. By the way, if I want to see what are my option Greeks at this time, I can look at my option Greeks that were available at that time. Now, the rules I use for a short put vertical may be different than the rules I do for a long call. Okay? And so there you go. Jay Taylor said, where do you see earnings? Well, looking back at the chart, when we were looking at it, earnings would have been right here on this. So this would have been, do you see, we got in on the crossover. The crossover happened to be like a day before earnings. You know, it doesn't have to be that way, but that's when we would have seen that crossover right there. Excuse me, and the earnings. So let's go back here. Let's say we did a short put vertical. I'm going to use the same parameters, even though often we'll do a short put vertical at a shorter time frame. But let's do that. I'm going to just change this to, well, first of all, I was giving the delta. We'll go to something between 30 and 40 delta. We'll go to the 60 strike, 60, 57, 50. Let me go to vertical, 60, 57, 50. I'm going to click on the bid price. We can see right here, that's what it was. And we're going to 9/14 as the end date. Remember, there's two dates here on this. Number one, number one, we have the start date. This is the start date. This right here is the end date. You need them both, okay? You need them both. And so, because our PL open, which in this case was positive if we did the short put vertical, shows the difference in trading strategies. Now, can you safely say a short put vertical is going to be a better strategy than a long call? No, in this particular case, because largely probably because of the time decay or theta involved, it did turn out to be a little bit better here. But that's what we got here on that, okay? So you can kind of see, and you can do multiple transactions there and test it out over and over. And now, here's the thing. When I said 30 data points minimum, okay, for kind of some statistical significance there on that, what you can't do is you can't just go to that particular point in debt time, 7/25 of 2022, and do 30 different trades on different stocks at that point. Okay? Why? Because there's market correlations. And in different market conditions, at sometimes, all the stocks are going to be doing really well, or all the stocks are going to be doing really poorly, or maybe not all of them, or most of them are going to do very well or very poorly. So you need to test it under different market conditions there. Okay, now, Chuck said, you need rules to exit. Yeah, absolutely. In my case, in this simple system that I was using, the exit rules were, I'm exiting on the crossover, on the negative crossover. In other words, the shorter term, the 20 crossing below the longer term. But you can use different rules, no doubt, to do that. By the way, there's a survey link in the chat here. Okay, let's do it. Let me give you the other way to possibly do this. Let me go to, I'm going to go to Oracle. Here's Oracle, 10 years. Again, I'm just going to zoom in on the chart a little bit, and then I'm going to scroll forward just so I don't know exactly where I am in time. I'm going to use kind of the same system. We're going to go here and we'll go to an entry on Oracle. There's a crossover, right? So you cross right there. We'll say, I think that's the valid day crossover. That was 4/5 of the year 2023. Okay, I'm going to scroll forward until we get that negative crossover, or whatever rule that you use. Okay, we happen to catch it at it seems to be a very bullish time. So I expect the results would be probably pretty good here on this. And we got the crossover here at 8/15/23. Now, this is not a recommendation of a particular strategy, a particular stock, any particular trades. I'm trying to just demonstrate some tools that you may use as you do this. So that's how to do this. The other way to do the trade is to go to On Demand, which is right here. So click on Demand. It's going to give me this little message, and I'm going to bring this up. And here's On Demand. I know a lot of you have never used On Demand. So let's talk about it. Now, if you look in the upper right, it says pre-buffering. It's slow, okay? It's slower than thinkback. It popped up relatively quickly here. One of the downsides of On Demand is in my mind, you're kind of going in this different system and it is a little bit slower. One of the upsides is you can get intraday data here. Now, I already wrote down the dates, but if I wanted to, I could scroll in and we can go to, let's go to April 5th of 2023. So let me go, I'm going to go to trade, and I'm going to change this date to 2023, April 5th. I'm going to click on that. And we're just going to say at noon, and this will be my time zone here. I somehow I did not do that well. Let me try this again. 12. Okay. April 5th at, well, 12:39. I didn't change the minutes on there. And you can see it's thinking, okay, that little message up there in the upper left, it's pre-buffering. It's getting the data for that day. You see that's a difference between the on-demand and the thinkback. Another difference, we don't get that pre-buffering thing with thinkback on that, okay? Now, let's do the same thing we did before. I'm going to use basically the same rules. I'm going to go out about 50 days. Well, I don't have 50 days. I have 44 days. Actually, but I'm going to go a little bit longer just because we'd end up rolling probably just because of the time frame. And June, July, August. Yeah, that should probably work. Okay. So, and we're going to buy so here at this time, at this date, at this time of the day, this is what the option prices were. Now, do you see, I can see what my bid-ask spread is on these at that time. And that's great. That's why I kind of clarified up front, we want to make sure that our liquidity is sufficient on that. Okay. So let's go here. Let me go and I'm going to go at the money. Stock's right around 95. So I'll go 95. I'm going to click on that. There's the purchase. And this, I haven't purchased it yet. I'm going to click on it and I'm just going to click on confirm and send. And I'm going to send that. And when I bring that up, if I go to the monitor tab, I'm going to see Oracle. That's the trade we just did. Well, look, only a minute has passed. You see, this is ticking like it was on that day. Only a minute has passed, so we're not showing much here. But what I can do is I can go forward in time right up here to August 15th. August 15th was my date. I wrote it down because I was going to forget otherwise. And click on that and click on go. Again, same time of the day. If you want to change the time of the day, you can do that. It's pre-buffering. We got to wait a little bit. And there we go. So we'll let that sit. And then what we can do is we can look at Oracle once the data comes out, and it should show us how our trade is doing at that point. There we go. Let's go back here. Monitor. And, oh, I went past our expiration date. June, yeah, I blew it. Okay, so do you see what I did there? I clicked on the wrong date. So I entered, silly me. Okay, let's go back. Let me go back to that trade here. Let me go back to April. I entered the wrong contract. So I was past expiration, so it wasn't giving me that. Well, in this case, here's what I'm going to do. I'm just going to go to May 19th. On May 19th, we won't hold it as long there. We're going to wait. And this is one reason why I often don't demonstrate on demand. It gets a little tedious waiting for the pre-buffering here to go, especially when we're teaching a webcast. But what I can do is I can look and see on that particular date, this is what my profit or loss would be there. Okay. So that makes sense going to May 19th because it's not after the expiration date of the contract. So, so there you go. All right. So if I were to kind of summarize think back versus on demand, there's a lot of overlap. You can do back testing either way. You got to wait. If you're switching dates a lot, you got to wait a lot of pre-buffering and stuff. Someone earlier, I think in the chat mentioned, they find it kind of glitchy, the on demand. Well, you may want to consider using that analyze thinkback function instead there. Okay, so now to get out of on demand, you just click on the little symbol right up here, and that should get us back to real paper money life here, which is what we have. Okay, so let me just do that, see if we have any questions, and then we will move on forward here. So test out different systems. You can accelerate the process. If you have an afternoon and you want to do it, and you want to do a lot of trades, this is maybe the way to do it rather than waiting real time to do them. Okay, so looks like Ben, you're helping out with finding earnings there. Chris says, Brent, I've often heard many option sellers preferring sell premium with an elevated mix. Yeah, that would be true. Is this a strategy that you've tried? If so, okay. All right. So I don't think, oh, okay, good questions. So I'll get to yours there in a sec, Chris. That's a good question. On demand is not available in the paper money account. Thank you. I don't know how to say your handle there. Dupuy in the chat. Yes, I should have clarified that. On demand is not available on the paper money platform. It's only available on the live platform. Okay, so that's another difference that I didn't mention on there. Now, one of the factors that we take into account is implied volatility. And if you've watched this webcast in the past with trades, or if you watch our condors, calendars, and butterflies webcast, which I teach on Fridays, or if you watch Ben's trading index options webcast, what you will hear me talk about, or you'll hear Ben talk about quite often, is implied volatility. And yes, if you are doing selling strategies, selling calls, selling puts, selling call verticals, selling put verticals, it benefits you typically if you have a higher implied volatility that you think is going to go down. It doesn't do you much good to typically have a high implied volatility if you think the implied volatility is just going to continue to go up. But if you see that higher IV and you think that IV is going to drop, now, then that may benefit selling strategies. Okay. Now, I think you mentioned the VIX. Well, the VIX is an average implied volatility for stocks in the S&P 500. Okay. If you're looking at individual stocks, let's say I'm looking at, I don't know, General Motors or something like that, I may look at the implied volatility on General Motors in that case, so you can kind of look at them both. Similarly, if you're trading out there, you may look at the overall market as well as the individual stocks. Okay, now let's manage some trades, because we have existing trades in here, and some of these aren't doing so hot right now, especially in our short verticals, iron condor, short puts category. That is, that's PL open for that category is, we're down, we're losing money here right now. Well, you win some, you lose some. Let's approach these, and not necessarily in order. One thing I would say is I was out of office last week. And one advantage, I try and do these trades in this class, and on some of these trades, I think we're down to 2 days. Normally, when we say we're less than 10 days to expiration, will kind of manage the trades, because they can go to really good or really bad in that time. In this case, Intel, we got down to 2 days. But here's the thing. This is just a short put. And very often with short puts, and we've talked about this in the past, very often with short puts, if you're doing it with the intention of, I'm going to buy the stock if it goes down, I'm going to buy it for a discount. Now you're going, well, it's not a discount anymore. The stock's at 34.60. I'm paying 37.50. Well, at the time we sold the put, it was a discount. Not anymore. But that's the deal you make when you sell the put. Sometimes you may just say on these short puts, I'm just going to let it go. I'm just going to buy the stock. Maybe it's a stock you want. So if it's something you don't want, you would buy it back. And this shows that, the danger of this. Look, we got a premium up front on this, but the premium is not going to be what it's going to cost us to get out. When we sold this originally, hold on a sec. We sold it for 93 cents. Okay. Well, I guess I didn't even have to click on that. I have the trade price, 93 cents. Right now, it's going to cost us multiple times that to get out of that. But if I'm willing to buy the stock, it's not a problem. I can just let it go, and we're just going to let that sit. Okay. So that's the first one. Short puts, if it's your intention to buy the stock from the get-go, then you can just let them run, even if they do go in the money there. Let's look at Wells Fargo. What do we got? Well, we've got kind of an iron condor thingy going here, but we have different numbers of contracts. We have two puts, and with iron condors, we always kind of manage them separately. Okay? So there's our put vertical. Here's our call vertical. And you know what? We have 2 days to go to expiration. When you're deciding to exit, and remember, you're going to decide your exit points when you enter the trade, not when there's 2 days to go on the trade. But when you decide those, you're going to have, what am I going to do? What am I going to get out if things are going well? What am I going to get out if things are going poorly? And what if it's just kind of hanging out and not doing one or the other necessarily? We'll have that exit. And in this case, under 10 days or a week to go or something like that, we're going to look to get out. In this case, we were out of the office. I didn't teach last week in this class. And so this would be one we'd normally look to get out with about that time. So we're just going to get out. Whether it's doing well or poorly, we're going to get out of this trade here. So, and what I'm going to do is I'm going to exit these out separately. Okay. I'm going to exit out the put spread separate from the call spread, just because pricing, you're probably going to be able to get more favorable pricing, I think. I can't make any guarantees on that, if you don't try and exit a whole multi-leg iron condor all in one transition there. Okay, now, let me create a closing order. We're getting out of the put vertical. We're going to do the same thing. It hasn't filled, but that's okay. We're going to get out of the call vertical. Okay? We're going to send that. Okay, so we're out of call side of things. Put side of things, it's doing okay. We'll wait for that to fill. Okay, now, questions. Intel, could we roll it? Yeah, we could roll it. If our intention wasn't to buy it, we could roll this straight out if we want. We could roll it out, say, a month or something, probably bring in a little credit there if we kept to the same strike. If we rolled it down to a lower strike, maybe it's something to explore. Could we maybe lower our cost basis in this? Well, let's look at Intel and see, because it's a good question, and I don't want to ignore the question. And so here's this right now. We said, I don't need that many strikes. We said it's going to cost us, about $300 to get out of this trade if we just bought it out right now. Let's say we go out a month. And what was our strike? Our strike was 37.50. I don't have a 37.50, but I could roll it down to 36. What if I rolled it down to 36? The net cost of that, buying back the one for 300, selling a new one for approximately, we'll say 300, is almost going to be a wash there. And I'm rolling it from a 37, agreeing to buy Intel. Instead of at 37.50, I'd be agreeing to buy it at $36. It would give me time for the trade to maybe recover if I want. But that's if I want. That's absolutely a valid approach there. John's list. It's a good question. I'm glad you brought that up, so we could talk about that. And kind of really what we should do is we should just let it get assigned at expiration, which it probably will because it's in the money. And the reason I say that is because that was our intention when we started the trade. And I don't want to change my intention. I don't want to change it at this point midstream, but there's nothing wrong with doing that. So good question. Let's see what we got there. So let me go and let's look at Apple. Apple, we got 30 days to go to expiration. So we're not getting out because of time. It's not looking so hot. It's a 260, 265 put vertical. We want the stock to stay above 265, ideally. Let's see. If it's just turned completely bearish on us, and I don't need that long a chart, if it's just turned completely bearish on us, maybe we'll just get out. And I'd say, no, it hasn't turned completely bearish on this. Okay. I'd say the general trend has been bullish. It's seen some weakness, largely probably just in sympathy with the rest of the market. Today's been actually a pretty nice day. We're almost up 1% today. So I'm going to stick with Apple, even if it is, even if it's not doing so hot right now. Amazon, not doing so hot either. In fact, it's doing even worse. When did we get in this? I don't even remember this. Oh, this was last week. Okay. All right. So, again, we got 30 days, so plenty of time. But at a certain point, it's time to cut bait. And if the trade's going bad enough, if we don't think it's going to recover, we may look to get out. Now we can add stops on these, and that probably applies to Apple too. 235 is where we want it to stay above on Amazon. Let's look at Amazon. AMZN. Oh boy. Do you see? This is, what day is this? That's the 13th. This is when the trade we got in. Look, this is what the chart looked like when we got in, right there. You can see it looked like this maybe was going to hold as kind of this island there. But then what happened was this, and then this, and then that. And it just keep getting worse. Am I bullish on this? It's hard to be. I mean, we want the stock to go up quite a bit. We can get out now. We can also just kind of draw the line in the sand there on Amazon. I could say, well, look, I'm going to take today's low, which is about 218, and I'm going to go a little bit below that. I'm going to go, we'll say 215. And if we cross below 215, I'm just going to get out of this. A lot of times we don't set stops on short put verticals, but in this case, I'm going to. Just so I don't have to manage it every day. And we're going to say if it goes below 215, we're going to get out, market, good till canceled. I'm going to click on the gear. We're going to get out less than or equal to $215. Okay. But if you decide this is no longer kind of a bullish trade, this is just completely bearish, just get out, save what you can on that. And we'll send that order. And now you can see that affixed to that. Now, I'm running out of time and I want to get to some different types of trades. So let's move on to the short, out of the short vertical category. Let's do a cover call. Let's go to a cover call. Okay. I think I have, if I'm not mistaken, let me get rid of this. I think WRB is a covered call. What do we got? Okay, we got covered call. Again, maybe better to manage a couple weeks ago. This is one that we can roll, though. Often we will roll covered calls. When do we roll? I don't care whether we're talking about covered calls, short puts, or anything in between. We roll when the rolling trade, the new trade, makes sense as a standalone trade. Don't worry about the past. If you lost money on the past trade, then it doesn't matter. That doesn't impact the next trade. When you roll, you're getting out of this trade and you're getting into a new one. Okay? So 2 days to go. Let's go and look to roll this. It's an $80 call. Let's look at the chart first, though. WRB. Okay. And I could say, well, here's our stock. What if we kept at an 80? Is that where we were at? We could look at the 80. What we can do is we can look at the delta too. So let's go to WRB. Let's go out about a month. Let's go to about maybe a 30-ish delta. There's our delta. We got a 28 delta, close enough. Kind of a bigger spread, but for our purposes, I'm going to stick with this here. Percentage-wise, well, let's say we can get a little bit more. Maybe not the exact mid price between the bid price and the ask price, which would be 90 cents. Let's say we can get 80 cents. If we can get 80 cents, then given the current price of the stock, that would represent about a 1% return, approximately a 1% return over 30 days of time. Fair enough. So is it a trade that I'd still want to do? If I've just turned bearish on this outright, and I just think the stock's going to go down, 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 then I may just want to get out of it entirely because I own 100 shares of stock, right? Like if I have a covered call, I own 100 shares of stock, which is basically 100, well, it is 100 delta, okay? If I own a short call on it, it depends on what strike you pick, but my delta is going to be, we'll just say, for example, a negative delta. My net delta on this is going to be about 70, okay? So it's still a bullish trade. So you don't do cover calls on stocks that you think are just going to be long-term down. But if you think it may go down a little bit and then recover, then it may make sense to do that. So that's kind of the consideration on the cover call. So let's do that. Let's roll this out. And we said we were going to go to, I forgot what we said we were going to go to, an $80 call December 19th. Okay. $80 call December 19th. Now, before I do that, let me just jot that down so I don't forget. Chris said, can you collar it above your entry? You can collar. What's a collar? A collar is you have a cover call, basically, and then you're going to buy a put below it, okay, to try and help protect you on the downside. Yeah, you can do that. You can add that in. So in this case, we're getting out of the call. We're looking at a new short call. And if we were to do the collar, we'd be doing a new long put on there. Long put, which is supposed to be short call. And doing that. Just think of it as a new trade. Okay. In this case, I'm just going to roll out that call though, but I think it's certainly a valid idea there, Chris, on that. But for time's sake, let's just roll that guy. So here's what I'm going to do to roll. Remember, rolling doesn't save you commissions. It doesn't. It's a new, we're getting out of this trade. We're doing a new trade. We're just doing a one order ticket. I'm going to right click on it. Will it let me? Right click, create rolling order. Okay. We're rolling to December 19th, 80. actually, it's rare, but when I clicked on create rolling order, it automatically set up the date and the strike price we wanted exactly how we wanted it. Usually, we got to tweak one or the other of this because it can't read your mind. But that's giving us about a 75-cent credit if we get filled on that roll there. And we'll stick with a covered call. I'm going to confirm and send on this. I'm going to send that, and it filled. And the reason we call it a roll is because it just kind of looks like we just took this trade and just kind of rolled it on down from the November to the December strike price. This all looks the same. We're done with this trade. We're into this trade, but that's what it is. We could have just as easily just bought this one back and sold this one fresh. All right. Now, there's a survey link in the chat, everybody. I'm out of time. I appreciate you joining me today. And I appreciate Ben for helping me out in the chat. You guys, I really do look forward to this each week. Coming up next, we have trading price patterns. Make sure you subscribe to that Trader Talks channel. And make sure you follow Ben and myself on X at Ben Watson, CS, at Brent Moore, CS. Thanks, everybody. See you same time next week. Bye-bye.